Namaste. Today we shall be going to the functional part of management. In the previous book we discussed about functions of management, wherein we discussed about the branches of management into the functions, planning, organizing, directing, staffing, etc. Now we are going to go in for the different functional management, the branches of management, namely financial management and marketing management. Now in financial management, we shall be discussing about business, finance and financial markets. Now to start with financial management, what do you mean by financial management? So in this lesson, we will be discussing about the meaning of financial management, objectives of financial management, then the importance of financial decisions, the various decisions taken by a manager in his position as a finance manager, and the impact of such decisions on the various items of financial statements. Then we shall be discussing about the most important aspect called wealth maximization concept. Now, coming to the lesson, meaning of financial management. What do you mean by financial management? So, to put it in a very simple way, simple words, we can say that financial management is that portion of management which is concerned with procurement of funds and their optimum utilization. I repeat, what do you mean by financial management? It is that part of management which is concerned with procurement of funds and their optimum utilization. Now, what are the objectives of financial management? Financial management basically talks about profit maximization, cost minimization, wealth maximization, availability of funds and safety of investments. Now, what do you mean by profit maximization? Any businessman will think of profit maximization. So, I invest 100 rupees. I should be able to get a maximum return on investment. What is maximum return on investment cannot be precisely defined, because what is maximum to me may not be maximum to you. Fine. So, profit maximization in general means aiming at a very high return on investment. But profit maximization cannot happen in isolation. Obviously, correspondingly, cost minimization should happen. Profit maximization cannot be achieved by just fixing a higher selling price. Higher selling price does not mean undue price being fixed. It has to be proportionate to the cost involved. So, cost minimization. Again, cost minimization means reducing the cost of production, cost of distribution, cost of selling, etc. But again, we cannot blindly say we can reduce cost. Which cost can be reduced? To a great extent, fixed cost can be managed. Variable cost cannot be reduced at all, because variable cost varies with the level of production. For example, you need this much quantity for producing one unit. For example, if you need this much of raw material, the raw material cost will be proportionate to the number of units produced. You cannot reduce raw material cost for the number of units that are going to be produced. Similarly, wages to the employees, factory fuel, oil, lighting, these are all directly proportionate to the volume of production. That means we cannot reduce cost blindly. Fixed cost. Fixed cost remains to be the same up to a particular point. That means to put that particular cost to the optimum use, cost can be minimized. But beyond a particular level, the cost will increase. So, cost minimization can be done up to a particular level. But a true prudent investor will look for wealth maximization. He is not satisfied with the short-term profit concept. A true investor will look for capital appreciation. So, he will only look for long-term gain. So, he will think that my capital, how much is it able to multiply over a period of time. Fine. So, that is what is called as wealth maximization. About this, we shall be discussing in detail in the next page. Now, coming to the next one, availability of funds. Any organization requires funds for various purposes. It can be short-term purpose or it can be fixed capital also. So, business organization requires funds for investment in plant and machinery, furniture, fittings, etc. And it requires funds for purchase of raw material, payment of salaries, wages, selling and distribution expenses, etc. So, funds should be available for appropriate purposes. Fixed capital should be available only for fixed investments, and working capital should be available only for meeting out day-to-day expenses. The manager must be very clear as to what is he putting it into use. The money that is raised towards fixed capital should be used only in acquisition of fixed assets, etc. And the money that is set aside as working capital should be used only for day-to-day purposes. It cannot be interchanged. Sorry. The next one is the manager has to ensure the projects in which the funds are invested are safe. A prudent investor will look for three principles of effective investment, namely safety of investments, liquidity of investments, and then only he will look for profitability. So, a prudent investor will not look for profitability directly. He will look for safety of his funds. Then he look for how quickly can he convert his investment into cash or cash equivalent. Then only he will look for profitability. So, it is the responsibility of the finance manager to ensure that the projects chosen are safe. Then only they can think of liquidity and profitability. So, these are the objectives with which a finance manager is expected to work. Now, the finance manager, will take three important decisions, which are called as financial decisions. The three important decisions are investment decision, financing decision, and dividend decision. So, all three decisions together are called as financial decision. Now, any change in any one of the decisions will have a series of impact on every other decision. Now, the financial decisions taken by the finance manager will have impact on every item of the financial statements. To state a few, now the first one is size and composition of fixed assets. The manager, suppose, is going to decide about investment of funds in fixed assets. Fine. It is going to involve huge investment. Bulk capital will be invested in fixed assets. We cannot say that investment in fixed asset means working capital will be less. Definitely not. For example, take the example of Integral Coach Factory. Fine. They are into the construction of the building of the railway coaches. Railway coaches, raw material cost is very heavy, long gestation period, huge investment is required. Yes, so fixed capital requirement is more. But does not mean their working capital will be less. Due to long operational period, more salaries will be paid, more administrative expenses have to be paid, which means their working capital also will be more. So, while investing money in fixed asset, the manager has to see whether the working capital requirements also will be more. So, his decision on fixed assets will have an impact on working capital also. Similarly, quantum of current assets and their breakup. This is a very important decision to be taken. Now, there are three items in the balance sheet of a company which are very, very crucial. Namely, inventory, debtors, and receivables. All three are called as inevitable evils. They are called as inevitable evils. Why are they called as inevitable evils? For example, to start with, stock, that is inventory. No business organization can say they will have zero stock at the end of the financial year. Then what will they do before the next production process commences and the products come out to the market? So until then, essentially they have to maintain stock, and that is going to block their working capital. How much of inventory should be maintained should be well decided. Only then minimum amount of capital will be blocked in that. Similarly, today's economy is a credit economy. No seller can say cash and carry system. Goods have to be sold on credit only. How effectively these debtors and receivables are maintained? If they are given a shorter credit period, then the working capital requirements will be less. If they are given a longer duration, obviously more funds will be blocked. So, if the total current asset consists of more of debtors, receivables and inventory, obviously funds available to meet out other expenses will be reduced because more amount of working capital is blocked. So, the manager's decision to maintain these assets at the optimum level or at the minimum level will benefit every other expenses. The next one is breakup of long-term funds into debt and equity. What is going to be the breakup between debt and equity? Both debt and equity have their own relative merits and limitations, which means if the company's finance position is good, satisfactory, the company can think of employing more of debt and less of equity. So that decision has to be taken very, very carefully. The next one is amount of long-term and short-term funds used. How much of long-term funds is required? How much of short-term funds are required? That decision again will have an impact on the profitability and liquidity of the business. Similarly, the last one, all items of profit and loss account. Now, the profit and loss account consists of indirect and non-operating expenses. Non-operating expenses are the finance cost. If the indirect operating expenses are kept at minimum, then the company can comfortably meet out its fixed commitments towards interest, etc. But if the salary and other administrative expenses proportion is more, then appropriate decision has to be taken for the borrowed capital which carries fixed return on investment. So, these decisions will have a series of impact on the profitability of the business. So, thus it says that very clearly that the financial decisions have to be taken very carefully. Now, we are going to go to the next topic, the very important topic called wealth maximization. The concept of wealth maximization says, of all the decisions to be taken by the finance manager, the most important decision is to be taken is to check how much return on investment can be provided to the equity shareholders. Why so much of importance given to the equity shareholders? Please remember, equity shareholders are the residual owners of the company. They are the ones who are bearing the brunt of the financial decisions taken by the finance manager. Any fortune or problems suffered by the company are borne by the equity shareholders ultimately. So that being the case, for all the sufferings or for all the risks that the equity shareholders are going to take up, they should be given good return on investment, maximum return on investment to the equity shareholders. The three important decisions which a manager will take in his position as a finance manager, namely the investment decision, the financing decision, and the dividend decision, must ensure that the equity shareholders are given good return on investment. The composition of securities chosen should be such that the equity shareholders stand to gain ultimately by the decision. The projects chosen should be in such a way that they are having a good composition of financing proportions and the results are able to give them maximum return on investment to the equity shareholders. So the wealth maximization concept essentially means that the shareholders' wealth must be appreciated by the various decisions to be taken by a finance manager. To recapitulate, today we discussed about what do you mean by financial management. Financial management is that portion of management which deals with procurement of funds and their optimum utilization. Then we discussed about the objectives of financial management, in which we discussed about profit maximization, cost minimization, wealth maximization, availability of funds and safety of investments. Then we discussed about the importance of financial decisions. All the decisions taken by a manager in his capacity as a finance manager are called as financial decisions. He will be taking three important decisions, namely investment decision, in which he will be deciding about the projects in which the funds of the business will be invested. Then, once a project is chosen, he will have to decide about the financing propositions. What are the various components of investments to be made? What are the sources from which funds can be mobilized to invest it in the project? Then, once a project is active, the project starts giving return on investment. Now, the sensitive decision to be taken is how much to distribute in the form of dividends to the equity shareholders and how much to plow back in the form of retained earnings. So, the three crucial decisions to be taken are called as financial decisions. Now, all these decisions are going to have strong impact on every item of financial statement. So, to quote a few, we discussed about the quantum of fixed asset, the total fixed asset, how much is going to be invested in the form of fixed asset, how much of capital is going to be blocked in the form of fixed asset. Then the second one is the proportion between fixed asset and current asset, how much of fixed asset and how much of current asset. Then the quantum of current asset and its breakup into the necessary evils, inevitable evils, namely inventory, debtors and receivables. If the manager is able to have a good control over these three, the manager will be able to have more amount to meet out other expenses and minimum working capital requirement will be there. Then we discussed about the amount of funds required into short term and long term. And the next one is breakup of long-term securities into debt and equity and their implications on the financial statements. And the last one is each item of profit and loss account, which is divided into operating indirect expenses and non-operating expenses. So, if the manager is able to meet both properly, then the decision will be good. These things we discussed. Then we went to the next topic. The most important topic is wealth maximization. The primary objective of any financial decision is to maximize shareholders' funds, shareholders' wealth. That can be achieved only by effective decision taken by the financial manager. So, the projects in which the funds have to be invested, the composition of funds to be raised, and how much to be distributed in the form of dividends will all decide about wealth maximization. So, any decision to be taken in relation to the financing proportions or in relation to the investment to be made, the manager must ensure that ultimately it is able to benefit the equity shareholders. So, equity shareholders are the residual owners of the company. They are the ones who are ultimately bearing the risk of managing the company. They bear the brunt of the financial decisions taken by the company and they are the ultimate risk bearers of the company. Therefore, any decision taken should ensure maximum return on investment to the equity shareholders. So, all these things together we finished in this. In the next module, we shall be discussing about the three important decisions, the criteria for those decisions, the factors influencing those decisions, and the financial blueprint of the company, namely financial planning. Namaste.